After this week, there's a lot of people that I saw in the chat room giving basically three different versions of what's happening this week. Number one, the theme was something's got to give. The second theme that I saw was Janet Yellen is my personal enemy. And the third theme I saw was what on earth is going on with this market. Well, in today's report, I want to pull back a little bit and show you guys maybe a little bit different perspective than you've seen before, which might answer some questions for you. All right, job number one right now that I want to go over is what I call market character. Market character. What on earth is that, you might be asking? You know, do markets have different emotions or different seasons, or, you know, what are you talking about here? Well, they sort of do. Markets go through different phases. Not every market is the same, right? And I think we can see this if we focus on the S&P 500. By the way, I tend to focus most of my analysis on the S&P 500. Everything tends to follow and kind of march in lockstep with the S&P. And as a result of that, it is, you know, it's the most watched chart in the world, right? And it becomes an anchor for us to be able to do our analysis, even if we're looking at individual stocks. So when we say the market, in my world, I'm looking at the S&P. So I'm looking at the 20-year chart on a monthly basis, all right? So a lot of times we don't spend any time looking at the chart on a monthly basis. But what I'm going to share with you is what I consider the four different market characters that we're going to see. Now, the most prevalent type of character is what's called a quiet and trending market. Quiet and trending market. And we see these a lot of the time. All right, the majority of the time we're going to see these quiet and trending markets. It's almost like Groundhog Day, right? Where you come into the market gaps down a few handles, and then within the first hour or so it tends to close the gap and then ends up squeezing higher in the day. How often does that happen? I mean, it happened like every single day back during this period, didn't it? I mean, it was Groundhog Day over and over and over again where we saw the same exact price action. Bears would get excited because the market had gapped down 4 to 5 points. Here we go. We're going to catch the top of the next great major bear market, okay? Bears are always too early to the party. Always too early to the party, and then they get on the wrong side of the market, and as we've seen really this week, get squeezed out to the upside. Okay, so phase number one is really what we see most of the time is quiet and trending price action, quiet and trending character of the market. And depending on what type of trader that you are, of course, if you're a bear, this is an absolute nightmare and you're hating life, right? So if you go to something like Slope of Hope or something like that, you're going to see people crying in their beer every Friday during markets like this. That brings up the second character, all right? What we run into is when markets are about to transition into something else. Now, I'll define what something else means in a minute. What we see is the market starts to get very unstable. The volatility, the realized volatility kicks up. Usually, to some degree, the implied volatility kicks up as well, too. But we start to see it become very unstable and kind of move around a lot. It's almost like the analogy I use is like if you've seen a dog grab a chew toy and just wave it back and forth really fast, you know, trying to snap its neck or something like that, right? This is what we see when we get into the beginning of what's potentially a corrective market. And this is what I call sideways and volatile. This is the second phase that we're going to see, the second type of character that we see, okay? Before a bear market kicks in, this is very important, before a bear market kicks in, we will see the market transition from a quiet and trending market to sideways and volatile. Sideways and volatile. So a lot of you are like, oh, so you're saying it's a bear market. Well, yes and no. The transition to phase number 3 is when it goes from sideways and volatile to trending and volatile. Okay, there is basically no trend inside these blue boxes here. There's really no trend inside of these, right? No trend in here. And then what happens is it starts to trend to the downside. It doesn't lose the volatility. In fact, the implied volatility usually goes sky high from this point. But the realized volatility, you can measure this through average true range or however you want to do it. But it typically keeps its realized volatility and gets worse and worse. In fact, what I read the other day was there's a new thing called the 60-30 rule, where 60% of the bear market losses occur in the last 30%, of the entire duration of the bear. Okay, so something interesting to note. Now that we all know it, it's probably never going to happen again. That's usually the way that markets move, right? But this is what I've seen, which is very consistent through the years, is that we have this quiet and trending migrates over to quiet and sideways, or excuse me, volatile and sideways, and then moves into the third phase, which is volatile and trending. Volatile and trending, right? Okay, so with that in mind, I'm not going to go over the fourth one because the fourth one is just quiet and sideways, and we almost never see quiet and sideways. We've occasionally seen quiet and sideways here. We actually saw quiet and sideways in the summer of 2015. Very rare to see it, especially in these days of quantitative easing. So now that I've laid that out for you, we were in what I considered when we moved to this move in January, all right, and actually August kicked this off. August of 2015 kicked this off, where we started to move into sideways and volatile, sideways and volatile. And actually I can make a case right now that with the lower high setting up in the monthly chart, which occurred back in December, and the lower low, which occurred in January and February, that we actually have, let me clear this up now. So I can make a case now that we have what is seeming to be going into trending and volatile to the downside. Now this rally we've had since mid-February has obviously put some question marks into there. So now we have what's called an inflection point in the markets, and this is actually huge that we identify this inflection point and understand what to do from here. Okay, so before I get into the next part here, let me recap really quick. All right, there's 4 different types of market character, 3 of which we see kind of rotate through a continuous basis, and usually when we have quiet and trending moving into volatile and sideways, usually it migrates to volatile and trending. And in fact, we can make a case that right now we are trending to the downside. We have a lower high and a lower low on the monthly chart. We have a monthly downtrend, which is very powerful. So for this to be reversed, has to make us stop and question what's going on. Okay, so this is why we get to this inflection point thing here. And so we're not going to be surprised by the next move. The next move is going to be potentially be worth maybe up to 500 handles on the S&P. It could be quite huge. Remember, there's something else that markets can correct through price or time. Usually a market will correct through price. You see a pullback, it corrects, and then it slingshots higher. I mean, this is a very, very common move, right? But what you can also see is a market will correct through time, where it actually just kind of walks sideways for a certain period of time until it's satisfied, and then the trend kicks into gear again. Okay, so we could see either one of these happening. Right now, this has actually been in correction right now for so long, for such a long period of time. This may satisfy the corrective need of the market, especially if we have central banks going full Venezuela, right, and saying we'll do anything necessary to push the markets higher. So if we end up going to the upside from this inflection point, what I want to make sure that you do is that you don't argue with the price. Price is always going to be right. The market is always going to be right. Make sure you make a deal with the market this weekend to say, okay, I release you. You can go higher or you can go lower. You can do whatever you want to, and I will just play along. My intent on doing this presentation for you is to show you that there literally can be 2 different divergent paths for the market at this point. So don't fit this into some box that has been laying around for 20 years and saying it's got to fit within this square peg has got to fit within this square hole here. And if it doesn't, don't bang that square peg into a round hole. Okay, so that leads me to my third point here is where to from here? Well, with this monthly downtrend in play, what should occur, and I put should in quotes, that if this monthly downtrend is still in effect, that we will see a lower high setting up here and eventually a lower low. Okay, that's a monthly downtrend. That's a monthly downtrend. So what would have to happen for either the monthly downtrend to kick into gear, or what would have to happen for the market to reverse and go to the upside? If you can follow along with my logic that I'm going to lay out here, this will pay huge dividends for you going forward. Here we have the S&P chart in 3 different time frames, and you're going to see me do this again and again with charts. You're going to see the monthly chart here, the weekly chart here, the daily chart here, and then we can even go down to smaller time frames inside of that. What these are tied by is a factor of 5. Each one of these is about a factor of 5 off from each other. The daily chart obviously is 5 times faster than the weekly chart. The weekly chart is roughly 5 times faster than the monthly chart. The reason why we do this, the reason why we complicate it with different charts, is so that we can see the patterns within the patterns. There's 2 major rules that I'll repeat again and again when I'm talking about analysis through what are called fractals like this, is that larger time frames dominate the trend, but reversals start from the inside out and propagate up to here. So in other words, think about this in life, that let's say you have a car and you drive the car on salty roads in Boston, Massachusetts. Right, so you go through a number of winters, you go through a lot of salt, you try to wash it off, but what happens is very, very slowly, very imperceptibly, the car will start to rust on you. You don't notice it as a step function. All of a sudden you look at the car one day and it's a pile of rust. That's not how it works out. Changes start from the inside out. They start with very small pieces and they start to spread larger and larger and larger. It's just like an illness. An illness, you typically don't come down, boom, all of a sudden you've got a major illness. It starts to work on the cellular level and it starts to multiply from there. So again, the 2 major rules here: larger time frames dominate. You can think of these as like the parent. This is the parent time frame. And you can think of this as maybe the child time frame down here on the daily chart, right? And then, you know, intermediate time frames in terms of that. But the monthly chart is a much more powerful chart. Think about this. Let's say you have a father and a young son, right? And they're going somewhere. And the father has got the young son in tow, and the father has some place to go. And maybe the son wants to explore over here and go look at something along the way. Well, guess what? He's going to get pulled right along by the father, who's got him by the hand, and say, "I'm sorry, son, I know you want to look at that puddle and step in the puddle over there and look at that frog, but we've got places to go." And ultimately, the larger time frame will dominate, in this case, the parent time frame. So in a lot of ways, this is how nature operates, and this is why I'm using charting like this, because I'm using charting in the same way that nature works. And this is how physics works and everything like that, right? So we break things up into fractal time frames and we see reversals happening from the inside out, but at the same time we keep our eye on the major trend, because the major trends are in control until they no longer are. Now, what on earth does that cryptic statement mean? Well, if they get reversed from the inside out. And so trends on the monthly chart don't change overnight. Think about the USS Enterprise aircraft carrier steaming at flank speed in the Pacific Ocean. And all of a sudden they realize, man overboard. There is some kind of turn, I forget the name for it, but I mean, it basically means that they have to heel the thing over on its side and sweep around on a 180. It takes miles of real estate to turn around an aircraft carrier. And that's how you should think of the S&P monthly chart, is like an aircraft carrier. Monthly time frames, the larger time frames will dominate. But if we keep an eye on what's happening at the lower time frames, even the intraday ones, we can start to see reversals. We can start to see erosion within the trend. We can start to see it migrate. And by doing this, we're not waiting for some silly indicator to tell us whether or not we should be bearish or bullish. We're actually seeing the structure of what's happening with the price. And this is what gets me excited. So before I go too long here and completely lose you, what we have here, let's look at the trend from, let's clean this up and let's look at the trend on each time frame. As I said before, the monthly trend, and let's kind of zoom in on this so you can see this a little bit better. The monthly trend is a downtrend. We have a market that was making higher lows and higher highs, made a higher low, lower high, lower low. Okay, so once we got into January, we confirmed the downtrend, that change in polarity to a downtrend on the monthly chart. That's a powerful signal. We almost never get those. The last time we had something like that happen was a long time ago. That was actually in early 2008 was the last time we saw something like this happen. Okay, so that's a major, major wake-up call. Major wake-up call that we don't see monthly downtrends happen very often. Okay, we've also seen a massively huge daily uptrend. All right, higher highs, higher lows. There's no denying the power of this thing. Okay, and this is also one big gnarly weekly swing. I mean, there's no higher lows in here at all. This is just one big weekly candle after weekly candle after weekly candle. All right, let me clean this up and kind of zoom in on the weekly chart here a little bit more so you can see this is just, there's no trend here. This is just one big honkin' swing, right? Let's get back to my original point for bringing this stuff up. What would we have to see for the monthly downtrend to kick in again? Okay, what would have to happen? Let's zoom in on the daily chart. What would have to happen is, remember what I talked about, reversals happen from the inside out. We have a daily uptrend, don't we? Higher highs, higher lows, higher highs. Unbelievable. Thank you, Janet Yellen, right? Okay, what would have to happen is we'd have to see the reversal start at the smallest time frames first. So how would that happen? We'd have to see something like this happen. Either we pull down next week and then a lower high sets up. And think about what happens even during the intraday when a weak bounce happens at the very top of a larger trend. All of a sudden, everybody piles into that, says, hey, let's buy the dip again. And all of a sudden, that gets sold into. All of a sudden, it's a panic, isn't it? Okay? So what has to happen is we have to see a change in polarity to the downtrend on the daily chart first. Now that, just because we pull down, everybody just watches the daily chart and gets overkeyed on what's happening at the daily chart. Just because that daily chart is trending to the downside doesn't mean anything. What happens then is that means that we maybe start pulling down into a weekly swing. This is normal. Even this is an uptrend, right? This is normal because we would expect after such a strong swing like this, we would expect at least the next pullback to create a higher low, a higher low. Here's the key, and this is the huge inflection point which is going to happen here in a number of weeks. Now I'm going to be watching this very, very carefully. I haven't seen one this important really since 2011. That was the last time I saw something that was this major. What can happen at this point is one of two things. Either the price bounces from this point and then kicks in another daily uptrend, which ends up taking out this level, wherever the high is, okay, wherever the high is, and then we confirm that, and this becomes yet another weekly uptrend, and this is going to kick in, okay, and eventually we'll take out this high. All right, so if this pulls back and rallies higher from here, then chances are very good, or at least they've strengthened considerably, that we're going to see energy released to the upside from this inflection point. Now, by the same token, what can happen is when we pull down here, let's go to a different color to represent the different scenario. If we pull down here, again, no big deal. This is normal. This is normal. We're supposed to have pullbacks in markets. They're not supposed to go higher all the time, forever. We're supposed to have a pullback here. Similar to what happened over here back in November. After that crazy October move, we had a nice pullback for at least a week here. Okay? So what could happen at this point is if it pulls up and sets in a lower high, precisely what happened over here, isn't it? It pulled down, set up a lower high, and then it started moving lower. Okay? So if this happens, and this would be very fast, this would be very fast. That would pull down this monthly chart like this. Now, we'd probably have some type of wave action in there, but be very, very cautious. So what happens after the next dip is going to be huge. Now, who knows how long that's going to take, whether or not the market's going to have to feel compelled to go all the way up here to 2100 and then pull back. You know, it's not going to be until everybody quits shorting this market and the last bear gets squeezed out. And then I think we'll see a very rapid air pocket show up. So pulling back to that higher low is no big deal. What happens after that is going to be huge. And I'd estimate that we're probably somewhere within a month of that happening. And when that occurs, that is going to be enormous. We're going to watch, I personally am going to watch every single tick of that, because that is going to dictate whether or not we go blasting into the stratosphere and become the next Venezuela, or whether gravity takes hold and says that earnings are not doing well. Obviously, earnings are going to be a huge key towards what happens here. But don't forget that quantitative easing can completely eradicate and null out anything from earnings, right? So this market is still addicted to QE, and you can see what happened to this market when we stopped pumping all those bond purchases in there. Okay, market got unstable. And so now Yellen has come out and said, woohoo, party's back on again. We'll do whatever. And you can see what kind of week we've had. I mean, maybe this is going to happen again, okay? We will be dealing with unintended consequences going forward in the future. We will. Nobody knows how markets will react to something like this. We've seen markets acting in a very different fashion. So what we have to do to survive is understand what the price is telling us. This price action analysis will not change no matter what happens with QE, no matter what happens with earnings, no matter what happens with time. As long as price is price, right? This will always hold up. Okay, so what I've tried to do, if you go back to the beginning of the presentation, I brought up those three things saying, this, something's got to give. Number one, I'm not happy with Janet Yellen. And number three was, what on earth is going on with this market? Hopefully that answers some of those concerns and gives you a different perspective on which you can sort of objectively look at this market and understand what's happening here, what phase the market's in, what type of character we're seeing, why it's doing what it's doing. And obviously what we'll do is, through the course of the week, start talking about, with this type of market character, what kind of edge do we actually find in this? What kind of option plays can we trade around this? What types of futures trades are we likely to see? How does the character influence the type of trade that we're going to be making and the selection for that? So I hope you guys join me. Again, I should be on in the afternoons, and I'm looking forward to this. I think this should be a blast, and we're all going to learn from each other. Have a great weekend, and we'll see you back here on Monday. Take care.